Welcome back to Behavioral Finance and FinTech. I'm Andy Kim, your Dr. Finance. We're going through the characteristic effect as an evidence against semi-strong form market efficiency in our class, right? And I told you that this is a basic building block of something called quantitative trading strategy. And this, in book-to-market effect, is what we've been going through. The book-to-market effect, how would you explain it, right? Behavioral finance guys say this is clear mispricing, okay? The market is not efficient, okay? You guys said that, these PB ratio kind of things, right? It's clearly visible, and then it is the publicly available information, so that we cannot make money if we try to make a trading strategy based on this publicly available information, but we can still make it, right? The neoclassical economists have a different take on it. They say it's not an evidence against EMH. The market is efficient anyway. But the fact that you found significant alpha, positive alpha, using CAPM as a benchmark means that CAPM is incomplete and you found some new risk factors. Okay. What kind of risk factor is it? In the size argument, it was not fully explainable, okay? But in book to market, they have better claim, better explanation, neoclassical economist. Lu Zhang in Ohio State University, right? He's a big shot guy. And then he has a value premium paper about it. The key idea is this: the value versus growth stock. You can compare this in terms of their, value stocks have a lot of assets in place, stuck in their balance sheet, so that they are inflexible to move around depending on the industry shock they face, which has nothing to do with industry shock may not be coinciding with the macro shock. Okay, your industries, pharmaceutical versus the confectionaries, and all different industries may have different industry shocks, technological innovation. Now, growth stocks are the ones that have a lot of R&D and patents, like IT companies, right? They have a lot of options to grow, okay? Option to grow. They have a lot of patents as a result of their R&D efforts, right? Research and development. They got patents. The 특허권. Should they mass produce? Like, for example, pharmaceutical companies, Pfizer, Moderna, or something like that. They have a lot of R&Ds and patents all around. Is COVID-19 related patent the only patent they have? No, actually, for tens of years they've been doing this R&D for a long time, so that they have thousands and thousands of R&D, the patents in their hand. They have growth option, whether to exercise it. One patent seems promising, given that we have certain viruses spreading out. We have related patent over there, so let's mass produce the drug related based on this patent. The other patents, forget it for now. Wait until those disease really hit the earth or something. Okay, they have a choice. Okay, they can be flexible whether to exercise and mass produce versus just keep on wait. They're nimble, okay, like this, right? In contrast, those value stocks, they are the ones who already exercised it. Too many already, hundreds of years. For example, Hyundai Motors, right? Hyundai Motor or Volkswagen. They already exercised those options and then developed into a combustion engine, internal combustion engine market for tens of years, decades and decades, right? GM, 100 years, Ford, 100 years, right? They have huge assets sitting in their balance sheet, in their assets in place. Now the labor union is also there. All of a sudden, what's the problem with this kind of companies? All of a sudden, the new technology comes in, like Tesla's electric vehicle, EV, or hydrogen vehicle, right? We're going to talk about that hydrogen issue later on. But new sexy technology comes in, which does not simply fit into this internal combustion engine, what should we do with these assets in place? And then, plus the labor union, they will strike. It's like they have to secure their own, income there, right? Labor unions, right? It makes you inflexible for your business. Of course, there's socially beneficial things related to labor union. I'm not trying to say anything against them, but from the management perspective, it makes you inflexible. So that's a risk. That is not simply explained by the macro level shock of recession versus economic boom time. Okay, it makes you less nimble. I frequently compare this as the guys or persons, unmarried versus married person with their children in their family. Just like myself, I'm 50 years old, and then I have 2 daughters. Right, I'm more of a value stock. Okay. Whereas if you look at a professor who is just fresh out of PhD and then is not married and then does not have any, of course, no kid there, those guys are more nimble to get a job anywhere in the world, US or UK, whatever country it may be. They can move around freely. They are free. They have growth option, just like the growth stock, right? A lot of patents. They have option. And just like you guys as well, you have an infinite possibility that you can, in the age of 20 or something. You guys are growth stock. Great. Everybody loves your position. I wish I were back to your age. That's that. In my age, right? And then my situation, right? Can I move around from here in Korea to try to teach in America for us all of a sudden? Well, my wife will be like, no way, Andy. No. We've been raising our kids in Korean system until now. You know how much pain we took, right? No Jose, right? No Jose. I have to be stuck over here. That's assets in place. So, my kind of situation would be more like a value stock. The thing is, somehow it's more risky for value stocks, but somehow it is more discounted, which is not captured by the market beta. So more discounted for value stocks, which means in the future it delivers better return that you anticipate, that you simply did not consider with this cap and beta thing. Okay, so that's the explanation of this book to market ratio, Lu Zhang's paper. Excellent one, right? Anyway, yeah, so that's that. And then also it has a lot commonality with the long run reversal, Devant and Taylor. They looked at the 5-year horizon in the past in your site, right? Those guys that were extremely outperforming, they tend to be growth stocks, whereas those stocks that have underperformed drastically over the 5 years, right? These guys tend to be more like value stocks. See what happens going into the future? Reverse is bad. Value stocks better perform. Okay, so that's that. Fama-French, the table, what do you see? These are the portfolios that 10 by 10 portfolio, you can think about it. So that small size to large size-based sorting is going on. For all stocks, you see size effect. Small stocks delivering better return than the large stocks. And on the horizontal axis, it's a 10 portfolios split based on book to market. Low book to market to high book to market. So growth stock to value stock, right? You see the growth stocks doesn't deliver that much return than the value stock. Value stocks tend to outperform the growth stocks. Okay, they tested using decades of data in their papers, and then these are mutually independent. You see this outperformance of the value stocks throughout the size deciles. Right? It's not explained away by size criteria. And then the size effect still prevails regardless of the deciles of book to market portfolio, right? So that's that. And then they try to explain it using this kind of portfolio formation. Portfolio, well, how do you form a portfolio to backtest this thing? Well, looking at the US stocks universe, all the stocks listed in the New York Stock Exchange and NASDAQ and American Stock Exchange, they sort two ways. Two-way sorting. First, they sort by size, small to big. Of course, there's some more complicated issues about how to classify it into this size group, but forget about it for your behavioral finance class. And then book to market, small to big, just you can think of it as just a medium cut, right? But small stocks and big stocks, and then book to market, well, you also sort these guys. For small group, you sort into in terms of with respect to the book to market, high book to market to low book to market, which is PB ratio based value stock over here for high value stock to growth stock. So it has to add up to 100%. So top 30% will be over here, right? So 100% to 70th percentile is high, and the medium is 40%, and then the bottom 30 percentile, right? It should be over here. So for small stock, thousands of small stocks, you sort them and then classify them into one of these categories, one of these portfolios, right? SH, small and high, right? Small and high. And this is small and medium, and small and low. And then the other is like a big high, big medium, big, oh, come on, big low. Sorry for this typo, BL, all right? Now you have 6 different portfolios, okay? Now, how do you estimate or how do you compute the return to the size-based trading strategy portfolio? Size-based trading strategy portfolio, we call it SMB portfolio. Size is like a small minus big portfolio. So that portfolio return, okay, in backtesting, you get first of all valuated returns of SH, SM, and SL, or each different 6 portfolios returns, right? SH, SM, and SL, and obtain simple average of these 3 small stocks, right? Portfolios, and then minus big stocks portfolio. Of course, I'm sorry, this has to be HML, right? L. And then take the average of these 3, simple average. Each of them are evaluated, but anyway, doesn't matter for you right now. SMB portfolio return. Now, what does this mean? If you look at this formula, okay, don't get spooked up when you look at the formula. Take a step back and take a deep breath and see what's going on a little bit, okay? This is a excess return excess return of what? The excess return of, return of small portfolio in excess of big portfolio. Small minus big, okay? Why do I say excess return? If you remember my refresher video about the CAPM, it was about the excess return, right? There in your left-hand side, there was your company's or your portfolio's excess return in excess of what? The risk-free rate. So we were talking about the risk premium, right, in that left-hand side. And then CAPM, there was a excess return on the market. Market portfolio's return minus risk-free rate, excess return. What is common over here is that this one is another form of excess return, purely based on the size category. Okay? Size category. Small stock minus big stock. So in excess of the other guys, how much do you earn as a small guy? Okay? Now, so the excess return is consistent with the idea of risk premium. All your risk premium should be explained by other risk premium. So that's our attempt to decompose those risk premium. You see, some of you may see where I am going at right now, but this is the formation of this SMB portfolio. Okay, small minus big trading strategy. How much do they earn? Okay, And then how can you really construct this kind of portfolio? We call it long-short portfolio. Long-short portfolio. So on the left item, this is a long portfolio's return. So S, this blue box, you long this position, long these stocks, thousands of stocks, and then short the red box, the stocks. Long short portfolio. So realistically, how would you do this? Well, if you are a hedge fund, right, then first you short these red box, the stocks, short position, and then taking a short position means that you borrow those stocks and sell it short. So today you will get the cash because you sold it. I know that you have to buy it back later on, but that's, let's say 1 month later or 2 months later, 1 year later, we don't know. Anyway, you get the cash. What do? Don't do something else, right? Don't drink, don't eat, but take a long position. Buy those blue stocks, right? So it's called a self-financing portfolio. Self-financing. You don't need to put any extra cash out of your pocket. Just purely based on the short and long position, you take this long-short portfolio, and then at the end of the period, you may end up, getting more money or losing some money. That's it. So that's how you construct this long-short portfolio and see their returns like this. How did they perform over the history of the United States since 1926 up until 2012? You see these size portfolio have been performing well if you look at the excess returns, right, left-hand side or right-hand side. Overall, they've been performing on average good, making money like 5 times or something like that, or 6 times. If you put $1 over here, it must have been like $5 or $6 more, right? Of course, there has been some period the size strategy performed very well, and there are some periods the size just did not work, or tanked. So you lost money, and then jumbo periods, like you have to sustain yourself. Hold on to this. But on average, right? Okay, if your grandpa, invested in a certain amount over there and then just stayed here, great grandpa maybe, you must have earned a lot of money in your family. That's a size strategy. And then here is 1962 to 2020, right? Period size strategy. You still have made this amount of money, like 150% abnormal return, okay, over this period. That's all still okay, fine. And then value strategy. How would you backtest this thing and then show it? And Fama-French demonstrated in those 6 portfolio approach. And then forget about the mid part of this book to market. Why do you forget about this? Don't ask me. They just excluded it. And then the return is much more drastic, I guess, over this extreme part, right? So that, what do? Well, take the average, simple average of these high portfolios, and then that's the first item over here. The second part, I'm sorry about the typo again, this has to be BL. So short position of these low book to market portfolio. That's growth stock short selling. No, growth stock, yes. So that's HML. Again, this is excess return form, right? Excess return. The high book to market portfolios excess return against low book to market portfolios. All right. Try to construct this in a coherent manner with those excess return framework, or the the excess return or risk premium kind of concept. As long as this is capturing some kind of risk premium, well, let's construct it in such a way that it will be easier to discuss it in terms of risk premium later on. So that's their intention. A return of high minus low portfolio. That's this guy. Okay. Now, how did the book to market or value strategy perform in the history in the US since 1926? Extremely good. You see this percentile, 4,000, like 40배. It's like a huge gain. Okay. Of course, there has been a lot of ups and downs. There's nothing it just happens for free, but there has been some crashes for this kind of value strategy. When do they crash? It is value strategy sucks when the market is in a huge bubble. For example, .com bubble period, right? Kosdaq, if you look at Kosdaq's index number, it was amazingly big, the .com bubble period. That's when the growth stocks, parties, and value stocks do miserably. So shorting those party stocks, miserable result like this. And it's until 2012, right? And then if you look back from 1962 to 2020, value strategy must have given you this amount of money, 300%, right? I put it in the scale, in the perspective with the size portfolio, 300% versus here. So size portfolio strategy was performing good, but only half as good as value strategy over the same time period. Okay, and then the value strategy rather performed rather stably, okay, compared to size strategy. That's that, and then so that's our backtesting results. And let me discuss something further in the next video. Thanks for watching.